Joining me today to discuss the macroeconomic outlook and its impact on the commercial real estate space is Calvin Schnure, NAREIT Vice President of Research and Industry Information. So Calvin, the economy seems to have gotten off to a pretty good start so far in 2012, and we got some good news last Friday. The government reported that payrolls rose 243,000 in the month and that the unemployment rate fell. Now, what's your take on these numbers?
These numbers were pretty good, Matt. Overall, there was good job growth in most industries. Average hourly earnings were up. It's a pretty good report, quite a bit stronger than consensus. The real important takeaway from this, though, isn't in any of the details. It's a real big picture question. For the past year, 2 years, the debate has been whether the sluggish economic recovery so far has been because of some temporary factors. We had the Japanese earthquake and tsunami interrupt the supply chain. The debt ceiling debate and Europe were both a real shock to the confidence with the financial markets being in turmoil. In some, there are a bunch of temporary factors that have been weighing on growth. But there are other people concerned that in the aftermath of a financial crisis, you can have a long-term impairment of economic potential. The new normal hypothesis, that would say we're not going to be able to expect stronger growth for quite a while. What we've seen, though, for several months now are building signs that the economy is gaining momentum, is getting back up to speed.
There's been a lot made about the long-term decline in the industrial sector in the United States. Now, one of the good things that we did see in Friday's report was some positive news about manufacturing. Now, what's your take there, and do you think this is signaling a turnaround in that sector?
Yes, Matt, the 50,000 jobs in manufacturing in January are a sign that that sector is starting to improve. In some ways, though, the concern about the overall health of the manufacturing sector has been a bit overstated. Yes, there's been a long-term secular trend loss of jobs, but part of that has just been because of efficiency gains, productivity gains. There have been some jobs shift overseas, but the ones that are left here are much more productive. What you can see right here is if you look at industrial production, manufacturing output relative to total GDP growth, where each of them is 100 in 1990. Manufacturing sector, the output of manufacturing has really kept pace with GDP growth over the past 20 years. In fact, it was above GDP growth for much of this time. It's much more cyclical than GDP, so it fell quite a bit during the recession, but it's well on its way to getting back in line where it was for the longer term. So really what we're seeing is the U.S. is retaining the manufacturing base it needs to have a strong and vibrant economy. Now, looking just at total manufacturing is not giving the whole story because there's a big shift towards some of the best areas in the sector. In particular, high-tech manufacturing has grown an awful lot. This is a higher value-added, higher profitable, and really an exciting new area. People tend to think that after the dot-com boom, high-tech is no longer the story. But if we look at the next chart, and keep in mind these green and blue lines now shifted down here, we've added the high-tech production to the picture. High-tech output is actually about 50 times what it was in 1990. So there's been a huge increase, and much of this increase has come over the past decade. The thin red line here is showing the peak at the end of the 1990s and 2000. Output of high-tech equipment is 2.5 times what it was a decade ago. So what we are seeing is this sector does have a lot of strength, does have a lot of vitality, and is still contributing to the U.S. economy.
Now that's good on the macro level. Now if we can bring it down and look specifically at the commercial real estate space, how does this impact industrial REITs?
Industrial REITs were fairly good performers last year and performed well in the financial markets in January. In addition to the rise in overall manufacturing production, other drivers are helping the sector improve. One of those is a rebound in global trade volumes. What we've seen is trade through the Port of Los Angeles has recovered quite a bit of the decline that it suffered during the recession. This is in spite of the fact that there's been a slowdown in Asia, slowdown in Europe. The economy hasn't had a whole lot of oomph to it over the past year, but even with that, the trade balances are recovering. In addition to international trade, inventories are another strong factor. Inventories, here the inventory to sales ratio has had a long decline over the past 20 years due to improved inventory management techniques, but they rose quite a bit in the recession. Inventories built up as sales disappointed, and that led to a high point in early 2009. Most firms have worked off the inventory imbalances that they had. So right now, it's closer to in line with its longer-term trends. Not completely down to where you'd have really lean inventories, but they're moderately lean, so you're going to expect to see some inventory build as sales growth improves.
And what are the risks on the horizon?
There's still quite a few risks to the outlook, Matt. First of all, it's just a fragile economic recovery. We're only now seeing overall GDP growth and the labor markets come back online. We're going to need to see a half a year to a full year of fairly strong growth before those risks recede. We also have other risks, of course, from the ongoing housing market crisis, the possibility of a spike in oil prices, the European situation, the European financial market situation.
Calvin, thank you so much for joining us.
It's been a pleasure.
For more on this and other REIT news and analysis, be sure to visit REIT.com.